Financial Accounting Chapter 8. Introduction. Measurement is the process of determining the monetary amounts at which the elements of the financial statements should be recorded in the balance sheet and income statement. This entails deciding on the appropriate measuring basis. Several different measurement bases are employed to different degrees and in varying combinations in financial statements. They include the following: historical cost, current cost, realizable settlement value, present value. Primacy of definitions. Those concepts are said to have conceptual primacy. In establishing the definitions of the elements, the board faced the challenge of deciding which definitions should have conceptual primacy. The principal alternatives were described as the revenue and expense view and the asset and liability view, simply stated. The former alternative would accord conceptual primacy to the definitions of revenues and expenses and base the definitions of assets and liabilities on those definitions. The latter alternative would do the converse, although either alternative seemingly would be equally workable and yield essentially the same result. That is not necessarily the case. Hierarchy of decision. This deals with selected aspects of accounting and preparation of financial statements following the national accounting standards, selected multinational system of accounting standards and their combinations. When deciding whether to keep accounts only following national legislation or following international financial reporting standards, various criteria are taken into account. As has been found, each of the criteria has a different weight. The most considered criterion is the level of costs. Moreover, several methods and procedures used by international financial reporting standards are characterized by a higher level of sophistication. The research results show that the highest weight occurs when the accounting is performed only according to national accounting legislation. The drawback of this option might be lower quality and limited comparability of financial statements. Income recognition. Revenue recognition is an accounting theory that specifies the circumstances in which revenue is recognized. In theory, there are a lot of different places where revenue can be recognized. This guide covers both IFRS and US GAAP recognition principles. Conditions for revenue recognition. According to the IFRS criteria, for revenue to be recognized, the following conditions must be satisfied. Risks and rewards of ownership have been transferred from the seller to the buyer. The seller loses control over the goods sold. The collection of payment from goods or services is reasonably assured. The amount of revenue can be reasonably measured. Costs of revenue can be reasonably measured. Performance refers to the first and second conditions, when the seller has done everything that is required of him in order to get paid, he is said to have performed. Collectibility is referred to as condition 3. The vendor must have a reasonable expectation of being compensated for his or her performance. Measurability is the term used to describe conditions 4 and 5. The seller must be able to match the revenues to the expenses according to the accounting principle of the matching principle. As a result, both income and expenses should be able to be measured accurately.